Guys, yesterday through my mid-week update, I told you that these two things. I told you, number one, there will be a gap up open in the market. Number two, the market will be bullish. And number three, I told you that because the market has already sacrificed itself on Thursday because it failed to hit 3840, this means that without any issues or without any major problem, the market will be able to breach 3840. Thereafter comes the 3884. This was the 3884. So I told you that whenever the market moves up, then it will see a very heavy resistance at 3884. And yesterday, if you have seen that around 3884, market has spent close to 3 to 4 hours. So market was hovering around 3884 because 3884 was very strong resistance for the market. Then I told you that if the market is somehow able to breach 3884, then thereafter comes the 3907. So 3907 will be the final resting place for the market. And if you look into the picture, the closing of the market is 3911. 3911. Market moved up, market hit 3907, then it formed a high at 3913. So if you have subscribed to the channel and if you are watching the technical analysis, then I always tell you that whatever the support and the resistance level, you should always use plus minus 5 or plus minus 10. Okay, so that will create the zone for that particular support and the resistance level. So support and resistances are not the absolute levels. Support and resistances are always the zones. Okay. And if you have watched my midweek update on June 23rd, that was Thursday, then I told you very, very clearly that on Thursday, the movement of the market will be restricted, it will be limited. Okay, means there will be a small candle, as you can see here in the chart, that there was a small candle on Thursday. Then I told you that because the Friday is going to be the weekly expiry, and on the previous Friday, the market failed to form this a heavy candle, that because the market failed to give very heavy movements on the monthly expiry, so those heavy movements will be clearly seen, will be 100% will be seen on this Friday, that was 24th of June. So S&P 500 has moved up by more than 3% on Friday, that was the weekly expiry. So once again, we have achieved an accuracy of more than 90% through the midweek updates, as you have seen. So guys, before I do this, the weekly technical analysis, let me answer the most common question that some of the people have asked. Okay, they were trading in the real time, and when they saw that the market is struggling at 3884, I told you that 3884 is the very strong resistance. So after seeing the 3884 and after seeing that the market is struggling, okay, for like 3 to 4 hours at 3884, okay, so they have decided to buy either to buy puts, okay, either to buy puts or to short sell. Okay, so I will not say that this was not the wise decision, but yes, this was indeed a wise decision, because the market was struggling at 3884 for 3 to 4 hours, and then after seeing this and after judging the market, okay, they have either bought puts or they have either went for the short selling. But what actually they missed, that market was trading between like 3872 to 3884. So market was trading between 3872 to 3884. Okay, so that is like plus minus 10. So market was already trading within the zone. Secondly, they forgot that whenever the market hits a resistance level, and if the market has to fail in this case, whenever the market hits the resistance level, okay, it will try for like 1, 2 or 3 or 4 times, then eventually it will come down, okay, by some heavy points. But in this case, yesterday what happened is that the market was trading in the zone between 3884 and 3872 or 3875. So market did not give this much of heavy fall. Market was, so this was the resistance, and market was just continuously hitting. Okay, so this was happening yesterday, means the market did not come down heavily as it was supposed to be. And that is the concept of the resistance, that whenever the market hits the resistance, okay, it may try to breach the resistance, okay, in like 2, 3, 4 times, but if that does not happen, then the market comes down heavily. in that case this logic is absolutely correct. In that case you must buy puts and you must short sell in order to make money. But when you see that the market is just hitting this resistance level again and again and is not giving up for like 3 to 4 hours, then that is something that you should consider, that because the market is not giving up, because the market is not coming down, that means the market is going to move up. And in future, okay, you may remember it like this, that whenever the market moves up in the first hour, okay, so this is the hourly candle, this is the first hour candle, and then comes the second hour, so market will give you a second hour candle, okay, a small candle. Then comes the third hour, market will give you, another small candle, okay. Then comes the fourth hour. In the fourth hour, either the market will come down or the market will move up. But if for some reason, if the market is able to survive for the fourth hour, then in the fifth hour definitely it will move up. So this is on the hourly chart. Remember, this is on the hourly chart. Okay, so whenever you are in doubt whether the market is going to breach or the market is not going to breach, then you should look for this kind of pattern, this kind of pattern. So this is not just one pattern. There are many patterns, hundreds of patterns, and you will learn these patterns when you observe the market on the daily basis, like for many months, for some years. Then you will recognize these patterns. Anyway, so this was the one thing, okay, why the short selling and buying puts, okay, it failed. Other than that, okay, I guess there were like 2 or 3 people, okay, who have commented and who have asked me this question, that will the market be bullish for the entire day? And I've answered that yes, that no matter what, the market will be bullish in the entire day, but I cannot comment on the closing, but the market will be bullish. Now, a few traders, okay, like 1 or 2 traders have mentioned that that through this thing, like through the puts and through the short selling, they have lost some money. So now let me answer that question. Now, in order to answer the question that how to save your money, okay, even if you are 99% certain, then also how to restrict your losses to 1%. Okay, so it is simple. See, yesterday I told you that 3884 will act as very heavy resistance. Okay, for 3 to 4 hours the market was trying to breach this resistance. Now when I say 3884, I mean plus minus 5 or plus minus 10, okay, in order to create the zone. Okay, this is what I tell you in every video, that the support and resistances are not the absolute levels. Okay, support and resistances are always the zones. Okay, and every zone has the lower point or the lower part and the upper part. Okay, so now if you are conservative, then you can go for plus minus 5. If you are liberal, then you can go for plus minus 10. Okay, now if we use the plus minus 5, then 3884 means 3 8 3 8 8 9, and then comes 3 7 7 9. Okay, if we use the plus minus 10, in that case 3 8 9 4 and 3 8 7 4. Okay, so approximately, so these are the approximate levels. So if you are not willing to take heavy risk, in that case, if you see that the market is struggling at 3884, okay, and you want to buy put options, you want to short sell, no problem, you can do that. But as soon as you place your order, make sure that you are going to place a stop loss around 3889, 3890 or 3891 maybe, or 3888. Okay, if you are conservative, in that case make sure that as soon as you place a short sell order, or if you want to buy put option, then your relevant stop loss must be around this point, okay, immediately. If you are liberal, in that case your stop loss, okay, must be around 3894, 3895, okay, 3896 or 3893, 3892. Okay, so this way what will happen, that even if you are 99% sure about something, okay, and if the things goes against, in that case, if you are conservative, like if you are going only for 5%, okay, in that case your losses will be less than 1%, less than 1%, okay, maybe like 0.4%, 0.7%. okay. Now if you are liberal, if you are going for this the 10, okay, in that case your losses will be limited to 1.5% or 2%. Okay, 1.5% to 2%. So this is how you should trade. Whenever you trade, okay, you must trade in this particular manner, in this particular way. Now guys, if you are watching my technical analysis and my midweek updates, okay, for last many days, months or weeks, okay, then you have noticed that I try to give you, as accurate numbers as I can in order to make sure that you avoid making mistakes. Okay, along with the numbers, I tell you exactly what is going to happen in the market, and most likely you have seen that because the accuracy is more than 90%. Okay, so most of the time we are able to deduce the most probable movement of the market, and the market behaves in that particular manner. So guys, before I do this, the technical analysis, let me remind you once again that from June 27th onwards, all midweek updates, okay, will be exclusively available to members, okay, only to the members. And if you're not joined the membership, okay, then you can join the membership. This is my YouTube channel, so all you need to do is to click on the join button. So this is the join button. So when you click on the join button, it will give you a pop-up. Okay, in this pop-up you can select, okay, either this one. This is only for $50, only one midweek update. Okay, so there will be like maximum of 4 to 5 midweek updates a month. And guys, there is one good thing with this subscription, that whenever you want to join the channel, you can join. Okay, whenever you want to cancel your subscription, you can cancel. And if you want to opt for all midweek updates, so there will be a minimum of 2 to 3 midweek updates per week. Okay, and if the situation demands, then there will be a maximum of 5 midweek updates per week. If you opt for all midweek updates, so you will get all of the midweek updates. Okay, no restriction, and the cost is only $150 per month. Anyways guys, so you can opt for either of these, only one midweek update or all midweek update as of now. So as of now, there are some members, okay, who have joined the membership, and all of these members have joined the all midweek updates. Now this technical analysis will be in two parts. First I will do it on the weekly chart, then I will do it on the daily chart, and this way we will be able to get the most accurate results as we are getting for last many months. Okay guys, so this is the weekly chart. Okay, let me write it down. Weekly chart. Weekly chart means one candle represents 1 week, not 1 day or 1 hour. One candle means 1 week. Okay, in the previous technical analysis, in the previous weekly technical analysis, okay, because the market found very heavy support on the 200 week EMA. So I told you that if for some reason if the market comes down, in that case it will again find some good support at 200 week moving average, and then we have 3630. Okay, but on Monday, because the open of the market was above 3710, and this was the reason that on Monday I told you that because the open was more than 3710, and that was the reason the SP 500 moved up. Now if you look into this, the candle, okay, this candle that was formed here for the week of 21st of June, the open was the low. Open was 3715.31. That was the low, 3715.31. The closing was 3911.73 and the high was 3913. Okay, this means that this candle is absolute bullish candle, absolute bullish. So absolute bullish, okay, or the absolute bearish, it happens. This happens when the open is either high or low and the closing is either high or low. Okay, whenever such a situation, okay, is seen, whenever we see such a situation, this means that particular candle is representing or is saying that the market is absolute bullish or the absolute bearish in the short term. Again, remember, short term. I am not saying the long term, I am saying the short term. Now what I mean by the short term, I mean that the impact of this heavy bullish candle will be reflected on Monday. Okay, on the candle that is going to form on Monday, the impact of this bullish candle will be seen on that particular candle. What kind of impact? First of all, okay, market will try to give you a gap up open because of this, the absolute bullish candle. Okay, and if there is no gap up open, okay, or irrespective of the open of the market will first try to move up no matter what. And if all other markets like European markets, okay, Asian markets, and if everything remains bullish, in that case the market will move up and up. Okay, and if there is some change in the markets, overall markets, in that case first the market will move up, and then thereafter, after some time, maybe half an hour or after 1 hour, okay, or maybe after 4 hours, then the market can come down. Now let me show you what kind of impact. If you see these two candles, okay, these two candles, so this was the very heavy bull candle, very heavy green candle, okay, and the high was the closing of the candle. Then what happened, okay, in the subsequent week, Upon open, the market moved up first and then the market come down. Okay, and this is what I'm talking about here. First the market will move up and then the market will come down. The market will come down only and only if the Asian and the European markets, okay, if they are not bullish, or if they are not doing well, or if they are bearish. Now guys, there is one more thing. See, whenever the market, okay, so market opens at 9:30 Eastern time. Market opens at 9:30 Eastern time. Okay, so the first 15 minutes are extremely volatile. Market is extremely volatile in first 15 minutes, then 30 minutes, and then 1 hour. So it is often advised that you should avoid trading. You must not trade until and unless you want to exit from the market. Okay, or if you want to book your profits. Okay, in that case you can use this particular time. So first 15 minutes or first 30 minutes, okay, market remains extremely volatile, particularly in case of options. If you are trading in options, then you will see that the premium price is very high in first 15 or 30 minutes, and then gradually during the day the premium price decreases. Anyway, so this was the interpretation of this candle, the bull candle. Now let's do the technical analysis. First comes the Bollinger Bands. This is the lower band of the Bollinger Band. This is the median of the Bollinger Band. Because the market is trading between the lower band and the median of the Bollinger Band, market is bearish through the Bollinger Bands. Then comes the moving averages. If you see that there is a clear fan out in the moving averages, market has closed below the moving averages, market is absolute bearish through the moving averages. Then comes the Ichimoku cloud. If you see that the market is trading below the Ichimoku cloud, market is bearish. Now guys, do not skip the video because soon I am going to show you the broader picture or the big picture of the market. Now comes the MACD. Now if you look into the MACD, MACD is less than the signal. This means that the market is bearish through MACD. Anyways, then comes the stock RSI. If you see that the K channel is less than the D channel, both K and D are less than 50, this means that the market is bearish through the stock RSI. Then comes the divergence in the closing prices of the candles. Okay, this divergence is normal as of now. Now if you look into the volatility is 199.34. 199.34. So looks like that every other week S&P 500 is breaking its own record of the all-time high volatility. Okay, so this is 199.34, and if the market remains volatile as it is expected to be, then by the next week it will hit the 200. The volatility will hit the all-time high in last 100 years of S&P 500 index in 200. Okay, the market will be extremely volatile. Market is still extremely volatile. Anyways, through all of the technical indicators, this is clear that on the weekly chart, market is clearly confirmed bearish. Okay. Now I remember that yesterday someone has asked me, someone has told me that he was watching the CNBC, okay, CNBC television, and he saw that people are talking about 4.2xx or 4.5xx. Okay. So they are saying that the market will hit the 4.2xx and the 4.5xx, okay, maybe in a month or so. Okay, then I gave him the answer that because see, the market is in control of bears, and this bear market, okay, this bear market is seeing after 2 years. This means that bears are not going to lose the control of the market. Market will remain bearish no matter what. Market will remain bearish. Okay, secondly, market is not expected to see the other side of 4035. So yes, the market has potential to move up a bit, okay, up to 4035. That's not a problem. Okay, but the market won't see the other side of 4035. Again, when I say 4035, okay, it's a major level. So again, plus minus 5, 10 or plus minus 15. Okay, so that will be the zone. So I told him that market will not be able to see the other side of 4035. Now the reason was, if you look into the economy, okay, economy is totally messed up. If you look into the supply chain is messed up. If you look into the output, the production output, that is messed up. Okay, and if you look into the jobs, people are losing their jobs, okay, and people are started to lose their jobs. And other than that, okay, the fuel prices are moving up. And even if you do not trust all of these factors, okay, then we have the inflation. Okay, inflation is trading at 8.60. And I've given you this, the S&P 500 index outlook for the year 2022. In this outlook, I have clearly mentioned that the inflation is peaking at 8.60 level. And I've given you many reasons why we are in the early stage of the recession. This recession will be worse. Okay, the severe impact of the recession will be seen in the winters. This Christmas, okay, you will see the severe impacts of the recession. Then post Christmas, okay, more and more impacts of the recession. We are in the recession. And other than that, I told you that currently the inflation is at 8.60. In the recession of 2008, okay, the inflation was at 5.60. Only 5.60. So in the recession of 2008, 2007 to 2009, it was 5.60. Currently it is at 8.60. Then how can you say that the market is going to hit 4,500 or 4,600? The only case the market can hit 4,500, or the only case the market can hit 5,000. Okay, this will happen only and only when, I repeat, this will happen only and only when the government start issuing the stimulus package. Okay, just like it did, okay, like $1,600 or $400. And because government is not going to give you any more stimulus checks, $400 check, $1,600 check, this means that there is no money in the market to fuel the market. So guys, as we have seen that on the weekly chart, market is absolute bearish. Okay, now let's move on to the daily chart to see what is happening on the daily chart. Okay, and also we will deduce the probable movement of the market as we always do on the daily chart. So we will see what is expected to happen on Monday, Tuesday, Wednesday, Thursday and Friday, etc. So let's move on to the daily chart. So guys, this is the daily chart. Okay, daily chart means one candle represents one day, not 1 week or 1 hour. One candle means one day. Now let me show you the big picture of the market. So guys, this is the big picture of the market. This was February 2020, this was March 2020, then this was December, this was January 2022. Okay, and this is June 2022. Now this is the big picture. So if you see that earlier the market was moving up, down, up, down, up, down, up, down, and this way the market was moving up. So this is the natural flow of the market. Okay, this is how the market works. Means the market will move up, then it will come down a bit, it will correct itself, it will form a higher low, then it will move up, higher low, then it will move up, and so. Similarly, whenever it is in the downtrend, it will come down, then it will correct itself, it will form a lower high, then it will come down, it will form a lower high, then it will come down, and so on. So this is how the market works. This is the natural flow of the market. Okay, now the reason why I was showing you this, the big picture, okay, so it will answer many of your questions. If you see that this is the current flow of the market. Okay, this is the current flow of the market. Market was coming down, up, lower, high, down, up, lower, high, and then some good, this is the correction. Okay, then again lower high, then come down, then up, then down, then up, then down, then down. Now it is forming a lower high. Now it is forming a lower high. Okay, so this was the reason why I wanted to show you the big picture. So see, this does not mean that the market is going to move up to this way. I've given you many reasons that why the market cannot hit 4,500, okay, or cannot be extremely bullish in this particular year. Okay, so this means that whenever the market moves up, and as you can see that the market is currently moving up, okay, this means that the market is going to form a lower high, okay, somewhere around. So that somewhere means that point. Okay, so we will deduce when we will do the technical analysis on the daily chart, but this is the natural flow of the market. This is how the market works. Okay, so market will form a lower high and then the market will come down. Now there is one more thing. This is the 200-day moving average. Okay, sorry, this particular, okay, this moving average, this is the 200-day moving average. Okay, So as of now, the divergence between the 200-day moving average and the closing price of the market, okay, this is acceptable. But because the market is expected to move up, this means that market may be market may hit like this level 4035, 4035, okay, or some other levels, and the divergence will remain in control. The divergence will remain in control. You can clearly see divergence, okay, in the 200-day moving average. So now this means that if you think that market will move up and hit the 200-day moving average, this is least likely to happen, least likely, because if the market breaches the previous high, okay, that it formed on 3rd of June, that was 4142. Okay, if the market breaches 4142, then definitely it will move towards 4200 or 4300, and this is something the bears, remember, the bears, market is in control of bears. Bears will, so these the bears will never let it happen, because as of now the market is in control of bears. Once it breaches like 4100, 4200, then it will be in control of bulls, and this is something the bears would never want, and they would never let it happen. So guys, we are on the daily chart, and now let's do the technical analysis first. So before I do the technical analysis, let me write down the support and resistance levels for you. See, as I mentioned earlier, that I'm not expecting the market to breach 4035. So 4035 will remain the most critical resistance for the market. And yes, there is one more thing, okay, I forgot that. I have mentioned this many times. Okay, along with the 4035, there is one more resistance, okay, immediate resistance, 4065. Now after this, the 4035, 4065, then we have the next resistance at 3989 or 3990, okay. Then we have 3938, or you can say 3940. Then we have 3883 dot something, so 3884. So 3884 is something that we have seen yesterday, okay. Then we have now this 3884 is going to act as support, not resistance, okay. 3884 will now act as support because the market has already breached the 3884. So it is now going to act as support for the market, okay. And then comes the next support at this was 3840. This was 3840. Then we have 3791. Then we have 3735, 3674, and between 3735 and 3674 there is one more the support 3710. Then we have 3630, okay, 3630, and you can say and you can clearly see that just above the 3630 we have the 200 week EMA, 200 week EMA, 200 week EMA, okay, just above the 3630. And now there is one more thing, guys, there is one more thing. Now let me make it very, very clear. Because the market found, you know, the very heavy support, just very heavy support at 200 week moving average two times. This means that the third time whenever the market will come to hit the 200 week moving average, most likely the 200 week EMA will fail to hold the market, and the market will breach the 3630 level, and it will come down to the levels, okay, that is the 3500 level. This means that now we have some good support at 3500, okay. So these are the support and resistances. So these support and resistances are not the these are not the pivot levels, okay, or calculated through the Gann calculator, or not through, you know, any other calculator. So I have analyzed the last 100 years of data since the inception of, you know, S&P 500, when it was S&P 233 and S&P 90, and then it was S&P 500, okay. So I have analyzed the data since the inception of S&P, and then I've calculated these support and resistance levels. Anyways, let's do the technical analysis on the daily chart. This is the lower band of the Bollinger Band, okay. This is the median of the Bollinger Band. The market has closed between the lower band and the median of the Bollinger Band. The market is bearish through the Bollinger Band, okay. So market is bearish through the Bollinger Band. Then comes the moving averages. Now if you look into the moving averages, Okay, let me just remove this thing. So if you look into the moving averages, there is a clear fan out in the moving averages supporting the bear trend, but because the market is trading within the moving averages, market is tangled between the moving averages. So in this particular case, okay, moving averages will act as neutral. And guys, there is one more thing. Okay, this is my advice that I have mentioned it many times. Whenever the market is trading in between the moving averages, never ever trade. Rather, you should wait for the market to clear the moving averages, either this side or this side. Because whenever the market is tangled in the moving averages and the volume is low in the market, overall in the market, if the volume is low, then the market, in this particular case, then the market will come down. Okay, and if there is enough volume, in that case the market will move up, means the market will breach all of the moving averages. However, if you want to trade, if you still want to trade, okay, in that case you are advised to use a very tight stop loss, particularly in this case when the movement of the market is in between the moving averages. Then comes the Ichimoku cloud. If you see that the market is trading below the Ichimoku cloud, this means that the market is bearish through the Ichimoku cloud. Then comes some other technical indicators. Okay, there comes the MACD. Now, if you look into the MACD is negative 86 and the signal is negative 85. This means that the MACD is trading below the signal. This means that there is no crossover in the MACD. This also means that the MACD, means through the MACD the market is still bearish. Now there is a catch. Now see, if on Monday, if the Asian, European markets, or if the overall markets, okay, if these markets are coming down, if on Monday, if this happens, if that all of the markets are coming down, in that case the crossover will never happen. Okay, in that case what will happen? In that case the MACD will slip. The MACD will slip just below the signal. And I have told you many times that whenever a slip is formed, okay, means mostly the slip is formed in the moving averages, the one, okay, that was formed here. So whenever a slip is formed, the slip is often an indication that the market is going to follow its usual trend. In this case, the usual trend is the bear trend. Okay, so even though you are seeing that the market is moving up, just one heavy bear candle, it will simply bring down the market, all of it. Okay, it will breach all of these levels, 3710, 3630, and then it will move towards 3500. Anyways, then comes the stock RSI. If you see that the K channel is more than 50, it is almost 51, and the D channel is 35 or something. Okay, now because the K is more than the D, it is bullish, and because the K is above 55, okay, so we can say yes, that overall the stock RSI is also supporting the short-term bull movement. Then comes the divergence. Divergence, as of now, it is normal. It is only 46.49. Sorry, 46.47. This is normal. Divergence means the divergence in the closing prices of the candles. This is normal. Then comes the volatility. Okay, on 23rd of June, the volatility was 95.96. Okay, and yesterday through midweek update, I told you that the market is still volatile. And if you see that yesterday, the volatility has increased again. It is 97.53. So the volatility is 97.53, means the market is again volatile. Anyways, through all of the technical indicators, except the stock RSI, except the moving averages, okay, market is bearish. Stock RSI is saying that there is a short-term bull movement in the market, and because the market has closed between the moving averages, okay, that is the reason why the moving averages are acting as neutral for the market. Now let's deduce the probable movement of the market, like how the market is going to behave on Monday, Tuesday, Wednesday, etc. Guys, let me tell you this one more thing, that this is the weekly technical analysis. Okay, weekly technical analysis. So whatever I am telling you in this weekly technical analysis, there are chances that when the market will move in the next week, okay, some adjustments will be needed in order to ride the market, okay, in order to trade in the market, okay. And that was the reason why I introduced the mid-week updates. So the weekly technical analysis, okay, this means that we are going to launch a space shuttle, okay, pre-programmed with the coordinates and everything. But once it reaches in the space, then okay, then it needs some adjustments, okay. So these, in our case, the adjustments, this is adjustments, okay, come through the midweek updates. And this is the reason why the midweek updates, okay, midweek updates have an accuracy of more than 90%, whereas the weekly technical analysis has an accuracy of more than 80%. So still, if you do not want to miss the midweek updates, then click on the join button, okay. The link is in the description. Now see that the market has spent like almost 4 to 5 hours in breaching the 3884, okay. This is the 3884. So the market has spent a lot of time to breach the 3884, and now the closing of the market is at 3911 above 3884. This means that now 3884, okay, which was acting earlier as a very heavy resistance for the market, is now going to act as a strong support for the market. This also means that if on Monday, if the open of the market is below the 3884, in that case the market will have to again struggle to breach the 3884, and most likely, okay, it will fail and it will come down. Then, and whenever it comes down, okay, it will find some good support here. That is this is 3791, okay, this is 3791, okay. And then the subsequent support levels, because we have seen a very heavy weekly candle and also a very heavy daily candle on the Friday. This means that irrespective of the open of the market will first try to move up, okay. Now this also means that if the open of the market is below 3884, this means that the market will first try to move up to hit 3884. It will then struggle around 3884, and if it is able to successfully breach the 3884, then it will move up, else it will come down. Now the other part is that if on Monday, okay, if the market moves up and if the market is able to close above this moving average will remain, okay, at this particular point. This is currently, it is 3928, okay. So you can say 3928, okay. The moving average is at 3928. So if the closing of the market on Monday, if the closing of the market is above 3928, this means that now the market has breached all of these the moving averages, okay, and market is on the bull side of the moving averages. This means now the market is most likely to hit this is what, this is 3989 or 3990, and then comes the 4035 and 4065, okay. These two resistances back to back, okay, and this is the very, very heavy resistance. Now the chances that the market will be able to break or to breach 4035 are very less. The reason is there comes the Ichimoku cloud, there comes the boundary of the Ichimoku cloud, okay, and the market will see, or the market will really struggle to enter into the Ichimoku cloud. So at most it can hit 4035, 4065, that's it, okay, or it can try to hit the boundary of the Ichimoku cloud, okay. And in the best case scenario, the market may even show that it has entered, but it will fail, okay. So it will enter and then it will come down, okay. So this is what is expected to happen. So this means the movement of the market will be limited by this resistance at 4035, 4065, then the Ichimoku cloud, and then comes the confluence zone. This is the confluence zone. So this confluence zone is at where? This confluence zone is at 4092 or 4091, okay, or you can say 4090. So this confluence zone is at 4090, okay. So there are these multiple resistances and the confluence zone. Now one more thing, do not forget that the market is in control of bears, okay. Bears are controlling the market. Secondly, whenever the market breaches 4100 or 4200, bulls will regain the control of the market, means the market will be then bullish, okay. And for that to happen, market has to breach the Ichimoku cloud, and that is something that is least likely to happen in the market, okay, in the coming days, coming months, coming weeks. Okay, so as of now, the movement up to 403565 or 4090, 4095, okay, that is possible. Now this also means that, okay, that if on the subsequent days, see, if the market is able to close above this, the moving average of 3928, this is 3928. If the market is able to close above 3928 on Monday, then Tuesday, yes, the Tuesday, okay, most likely the market will see another day, market will be bullish, or even if the market will be bearish, then also the closing of the market will be above 3928, because the market will then try to hold above the 3928, okay, or you can say our next this the resistance is 3938, okay, or 3940, 3935. So the market will then close above the 3935 or 3938, okay. Now if on Tuesday if the closing is above 3928, sorry, 3938, okay, in that case on Wednesday the market will further move up, and this will be the time when the market will meet 3990. This is 3990, sorry, this is 3990, okay, and also at 3990 it will find, okay, another confluence zone. So 3990 is the calculated resistance, and also there is a confluence zone. So whenever the market moves up and it hits 3989, 3990, okay, the zone of 3990, then the market will struggle a bit, okay, and that is the case, okay, when the market may form a lower high and the market may come down, okay. Then if it breaches this, the 3988, sorry, 3990, then we have 4035, 4065, etc. Now let's use the fifth retracement to see to what level the market can retrace and what will be the approximate level where the market will form a lower high. So when we apply the fib, okay, the fib says 3971, okay, just around 3971. So this means that the lower high that we are expecting here, okay, the lower high is expected to form around 3971, 3971, okay. So when I say 3971, okay, so around 3971 or exactly at 3971, okay, there we can expect a lower high to be formed. So when we look into the 3971, this means that if the market forms a lower high at 3971, in that case the market won't be able to hit 3990, okay. See, most of the times what happens is that whenever the market hits 61.8%, 61.8% of the fib, okay, it is considered as the standard retracement level of the Fibonacci. So I have made a video on this, the Fibonacci, what the Fibonacci is, okay, the Fibonacci retracement strategy, so you can watch that particular video. So 61.8 is the standard, okay, level. 61.8 this 61.8% is 3971, okay. So this does not mean that the market will hit the 3971, the absolute price, and it will come down. See, most of the times it happens, but sometimes what happens is that it can breach 3971, it can come to hit 3989 or 3990, and then it can come down, okay. So that will again act as the lower high level. This means that if you see that the market is struggling around 3971 or 3990, in that case the lower high will be formed there. And also you need not to worry, okay, because I will do the midweek update, okay, and through the midweek updates, okay, I will guide you that when and where the lower high is going to be formed, and where you should, you know, buy put options, okay, and short sell, or if the market has breached the lower high, or if the chances are less that the market will not form the lower high, in that case I will guide you that what is going to happen next, okay, where the market is heading to, and then after hitting what particular level the market will come down, okay. So guys, if you have not subscribed the channel, okay, then subscribe the channel and you will get the weekly technical analysis, okay, and also you can join my YouTube membership program to get the midweek updates. I will also post very informative videos, okay, like the outlook for the SP 500, okay, and then so soon I will make another video on that how the market manipulators manipulate the SP 500 index. And thereafter, okay, I'm planning to make other informational videos, okay, on the S&P 500 index and overall the economy and the market. So in near future you are going to learn a lot of things. So subscribe the channel, okay, and if you are subscribed, then make sure you click on the bell notification icon so that whenever I upload a video, so you will get instant notification. Okay, and guys, there is one more thing, because on June 27th onwards, okay, the midweek updates will be available exclusively for the members. Okay, so if you can join the membership to get the midweek updates, then you are most welcome. And if for some reason you cannot, okay, then no problem, then you can watch this the weekly technical analysis, okay, more than once, more than twice, and also wait for my comments. Okay, if you see my comments there, okay, then act accordingly. And if you do not see my comments, okay, in that case just follow this the weekly technical analysis. So guys, don't forget to subscribe. So this was my weekly technical analysis for the week of June 27, 2022 of S&P 500 index.